You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we'll be discussing British American Tobacco, Unilever, Reckitt Benckiser, Games Workshop, Shell, and Alphabet. There'll also be a book review of The Great Depression, A Diary by Benjamin Roth at the end. So John, should we kick off with British American Tobacco?
Yes, so British American Tobacco had their half-year results out this week. And for anyone who doesn't know, British American Tobacco are the largest tobacco company listed on the FTSE 100 and the world's second largest tobacco company. So in terms of their half-year results, combustibles revenue was up 5.8% to £10.5 billion, with price rises and a small increase in volumes of 1.5% accounting for that. US revenue rose 9.1% to £5.6 billion, with growth of 8.1% in combustibles to £4.8 billion. Volumes actually fell 4.3%, so the revenue rise was down to price increases. New categories, so that's products like e-cigarettes and heated tobacco, saw revenue growth of 55% to £243 million, with particular success of the Views brand, which is closing the gap on the market leader in the US. Operating profit was up 9.7% to £2.8 billion. In Asia Pacific and the Middle East, revenues climbed 5.8% to £2.1 billion, with revenue in combustibles up 6.7% to £1.8 billion, with an 8% increase in volumes. New categories fell 1.1% to £228 million, but that was primarily relating to the impact of the excise payments in Japan. Operating profit rose 2.8% to £868 million. In Europe and North America, revenue rose 5.9% to £2.8 billion, with revenues from combustibles falling 1.2% to £2.3 billion, with volumes down 3.4% in combustibles. However, in the new categories, so again, it's the sort of the next generation of the products. Revenue rose 113% to £358 million, with growth across all categories, but particularly the tobacco heated products. So that's sort of almost like smokeless tobacco, but not e-cigarettes. So it's sort of heated tobacco products where they form a vapor rather than burning. And that was in the form of their Glow brand. Operating profit fell 3.7% to £709 million. And overall net debt fell 8.5% to £40.5 billion, or 7.6% excluding the impact of exchange rates. In terms of valuation, price to earnings going forward is 8.1, with a 10-year average of 13.6. And British American Tobacco has a market cap of just over 61 billion, and it has a prospective dividend yield of over 8%. Sam, what were your thoughts on these results from British American Tobacco?
I thought they were very good results. Obviously, the stick sales were pretty good, but then the new categories, 50% growth was very impressive. That's now making up 7% of revenue. And if it carries on growing 50% a year, well, I mean, at a P of 8, it's not really priced like it's got a future. And if new categories grows at 50% a year, it probably will do. So yeah. I think it's very underpriced if that new categories can carry on growing.
Yeah, and I think that was probably, I think that was the pick out of all of that, really, was that the growth in the new categories. And I mean, it's very impressive what they're able to do in terms of pricing power. I don't think there are many other companies that are able to do that, despite, obviously volume declines. I suppose there is a small amount of growth in sort of stick volumes in some of the emerging markets, but I guess it's a picture that we've seen with the tobacco companies for a number of years, where stick volumes are falling, especially in the West, maybe growing slightly in the emerging markets, but not enough to offset the sort of the West. But they've been able to, raise prices to offset that. But I mean, that obviously can't continue forever. And I suppose some of the other concerns more broadly with British American would also be a potential menthol ban in the US. And of course, they did pay a lot for Reynolds Tobacco, which included the Newport brand, and that's primarily menthol. I suppose other issues, but this would apply to tobacco more broadly, would be any limitation on the content, the nicotine content and sort of nicotine levels and nicotine limits in cigarettes. And that's probably not that likely, but it has been mooted. So, that could potentially be devastating for the tobacco industry if it ever came in. But I mean, I guess the most encouraging thing, as we've said, is the increase in these next generation products, which aren't sort of traditional combustible nicotine, which, potentially would be good for these companies. And also, it would be a form of harm reduction. Obviously, nothing's better than not smoking, but the next generation products are obviously healthier than smoking traditional cigarettes. Yeah. Well, so Sam, would you be, ethics, I suppose, aside, what would you think in terms of buying British American tobacco?
I wouldn't be against it. I think, like you said, there are regulatory risks, but at a PE of 8, I think that's more than priced in. I think at a PE of 8, realistically, it's probably got a pretty good chance of distributing. You're probably going to get your money back in dividends before the cash flows run out. And then if new categories carry on increasing, you're going to get more than your money back, because there's actually, at that point, you have to consider, if the terminal value is not nil, it's very underpriced, I think.
Yeah, they've perhaps been oversold partly, because of ESG investing, and people have been selling out of them irrespective of the fundamentals.
Yeah, but I guess that means if you're investing now, you're not going to invest with the hope of like a multiple revaluation. It's just the amount of cash you're going to get out of it. And because so much of that cash is being distributed as well. Yeah, no, I agree. And I mean, at the moment, it's primarily through dividends. I'm not sure whether there are any plans to do share buybacks in future. That might actually sort of, I suppose, boost the share price. But at the moment, it is just redistributing the cash to shareholders through the dividends. Yeah, I think whether they increase the dividends or decrease the share count, you're still getting that cash back, aren't you?
Yeah, you are. Okay, so next on the list, we have Unilever. Sam?
Yes, so Unilever, for anyone who doesn't know Unilever, you'll almost certainly be familiar with their brands. I'll just get a few of them up just in case. Yeah, so the brands include Cif, Cornetto, Domestos, Dove, Hellmann's, Magnum. The list goes on and on and on, so I won't go through them all. Vaseline.
Ben & Jerry's, of course.
Yeah, so lots and lots of brands, lots of very high quality brands. They've come out with their half-year results, and they reported underlying sales growth of 5.4% in the first half, with the majority of that coming in the second quarter. Each business segment grew, with the best performance coming from beauty and personal care. Geographically, there have been improvements across Unilever's markets, but things remain volatile. Underlying operating profit fell 4.7% to 4.8 billion euros as high cost inflation and increased marketing spending dented margins. Growth was largely driven by volumes, which increased 4%, whilst prices rose 1.3%. Asia saw the strongest underlying sales growth, which was up 7.7%, and the Americas grew 5.1%. Europe rose 1.1% overall. Growth has slowed in Europe and the Americas as the group lags the exceptional demand for hygiene and food products at the start of the pandemic. Online sales rose 50%, and these now account for 11% of sales. There was 3.3% unit sales growth in beauty and personal care, with a fairly equal split between volume and prices. Skincare grew double digits, while deodorants returned to growth. Growth accelerated in the second quarter as living restrictions lifted in some markets. Underlying operating margins fell 2.2% as Unilever increased marketing spending and there was high cost inflation. Home care recorded unit sales growth of 4.5%, which was entirely driven by volume as prices fell 0.3%. Fabric cleaning and fabric enhancers did well in the half. Home and hygiene sales declined mid-single digits. Underlying operating profit fell 1.3% because of increased marketing and cost inflation. Improved ice cream sales inside and outside of the home helped food and refreshments unit sales growth rise 8.1%. 5.8% came from volumes, and the rest came from higher prices. Out-of-home ice cream in Europe saw double-digit growth as living restrictions began to ease, but sales haven't yet returned to pre-COVID levels. Magnum and Ben & Jerry's recorded strong growth. Food Solutions also grew double digits, but turnover hasn't yet recovered to 2019 levels. Group underlying operating margins fell from 19.8% to 18.8% as Unilever stepped up marketing spend after cutting back during the lockdowns, and this was also impacted by higher commodity costs. The separation of the tea business is due to complete in October, and the group is considering an IPO, sale, or partnership for these assets. Unilever is also considering the options for its Elida beauty portfolio. The brands include Q-Tips, KRS, Tiggy, Timote, Impulse, and Monosaven. The lower operating profit meant free cash flow fell from 2.9 billion euros to 2.4 billion. Net debt was 22.4 billion at the end of June compared to 20.9 billion at the start of the year. In terms of the valuation, it's now trading at a PE ratio of 19.4, and that compares to a 10-year average of 19, and the prospective dividend yield for the next 12 months is 3.5%. John, thoughts on Unilever and these results?
I mean, I like Unilever as a company. I think, as you listed the brands at the beginning, they're incredibly high quality and they have a very loyal following. They've got margins close to 20%, which is pretty good. And, again, something a lot of companies could only dream of. I suppose the revenue growth was pretty reasonable and maybe slightly ahead of expectations. I guess that the concern is that the operating margins are down 2%, and there's that I suppose, ongoing inflation and the fear of more inflation going forward, eroding that. I suppose in the short term, it is a concern and leads the results to be less impressive than they otherwise would be. But I think if you're buying Unilever for the long term, it might even, in fact, be a good time to buy, because I don't think it's certainly not expensive at the moment compared with where it's been historically and where it's been in recent years. It is about in line with its 10-year average, but it's, quality company, and it's got a fairly secure and decent dividend yield of about 3.5%. So I would probably be buying Unilever today, even despite the concerns of higher inflation. What about you?
I thought they were good results. I thought mid-single digit sales growth is probably about as high as you can expect from a company like Unilever. Yeah, I thought it was quite good. I'm not particularly concerned about the margins, just because I think that marketing spend has to go up. It really, it's not going to be very often that Unilever are in a position where they don't need to spend money on marketing and people are queuing, waiting for the shops to open to go inside and buy their products. That's just not going to happen again. And then for the commodity prices increasing, I think they can pass that all on to customers. So I don't worry about that at all. So if margins have peaked, it's not something that concerns me, because you've had this possibly once in a lifetime event that's meant they've not had to spend on marketing as much, but people want to buy more. So no, I thought they were good results. I think the valuation is pretty reasonable. We've seen it in the low 20s, and that's quite pricey. Whereas I think, given the quality of the company, the fact that it is growing mid-single digits, and that 3.5% dividend yield is not only very secure, but also pretty reasonable, I think a PE of 19 is pretty fair.
Yeah. And I mean, it's the market didn't like this news, and the shares were down nearly 4% on the release. What do you think about the market response to it?
I'm surprised, to be honest. I think it could have been a lot worse. I think after the year they've had in 2020, especially, with the cleaning products and stuff like that, I think mid-single digit growth is impressive, because they're up against quite tough comps now. Yeah. So it wouldn't have surprised me if it had been pretty flat.
Yeah. Yeah. So actually, you think it's probably a bit overdone. But yeah, I mean, I think it would be. I have Unilever shares, but I'd consider adding to them. And if I didn't have any, I'd probably be buying some.
If all these results, someone had told you that up against the tough comps of last year, you're going to have sales growth in the mid-single digits, would you have taken it?
Yeah, I would absolutely have taken it. That's, no question.
Yeah.
Fine. Okay, so on to another consumer goods company, Reckitt Benckiser. They had their half-year results out. And for anyone who doesn't know, so they're essentially the second biggest consumer goods company on the FTSE 100 after Unilever. And they make brands from Dettol, Finish, Cillit Bang, Durex condoms. They've got a fair portfolio going on. And their results, first half like-for-like revenue came in at £6.3 billion, which was a 3.7% increase, excluding the sale of the Chinese infant nutrition business. This reflects changes in pricing and sales mix and a modest increase in volumes. However, operating profits overall were down 5% to £1.4 billion, with increased investment and cost inflation. The group plans price increases in the second half to offset the rising costs, but expects full year margins to decline by between 0.4 and 0.9 percentage points. So in a little bit more detail, then the e-commerce side of the business, net revenue actually rose 15% in the first half to account for 12% of overall revenue. The North American division was the strongest performing region again, with revenue growing 6.3%, and that really reflective of the growth in hygiene brands. Developing markets saw revenue growth of more modest, 0.5%. However, in Europe, Australia and New Zealand fell 1.9%, with declines in Germany and Australia offsetting the growth in the UK and France. Overall, though, revenue in hygiene rose 18% to £3 billion, with double-digit volume growth and strong pricing. Demand for products like Lysol remained well above the pre-COVID levels, although growth had tempered in the second quarter. Operating profits increased 21.5% to £774 million, with revenue offsetting increased investment and cost inflation. Due to a weak cold and flu season with social distancing meant that revenue in the health division declined 10.2% to £2.1 billion. Profits fell 30% to £468 million. Income from Dettol declined in most markets, but revenue is still 40% above 2019 levels. And nutrition revenue fell 8.5% to £1.4 billion, with a weakness in the Chinese infant nutrition business, which is to be sold in the second half for about £1.3 billion. Excluding this, revenue was down 0.9% due to volume declines, and profits fell 3.9% to £183 million. Free cash flow declined from £1.9 billion in 2020 to £520 million today, and net debt rose £130 million to £9.1 billion as the final dividend more than offset cash flow. In terms of valuation, Reckitt trades at a price to earnings of 19.5, which is in line with the 10-year average, and has a prospective dividend yield of just under 3%. So it's, to me, the picture, margins are obviously under pressure with the cost inflation, and it is concerning of some of the sales decline, particularly in the health and the nutrition, but the results are partially distorted as a result of the pandemic last year. And it's still, like Unilever, has some very strong brands, perhaps not quite the quality of Unilever, but they're still pretty good. And again, like Unilever, has a better online presence with the e-commerce making up 12% of the total revenue. And actually, that's a 95% increase compared with 2019. And obviously, the greater margins on that. And despite taking the huge hit, offloading the sort of, what it has been the floundering Chinese infant nutrition business, hopefully going forward, it'll be a healthier company and it'll be able to pay down some of the debt as well. Sam, what were your thoughts on these results and on Reckitt more generally?
I thought they were decent results. I didn't think they were quite as good as Unilever's. So, I mean, for me, the most comparable thing is if you just take the revenue growth, and if you exclude the sale of the infant nutrition business, it was 3.7%, which is obviously lower than Unilever's. I know that more of their brands are sort of geared towards cleaning, which would be why. So I think it's pretty reasonable. I think 3.7% overall increase is pretty reasonable. And like Unilever, we would have expected the margins to decline. So a 5% operating profit decrease. It's on the back of the year that they've had last year. It's not something that concerns me. The shares have pulled back quite significantly on this.
Yeah.
And I mean, we've covered Reckitt at least twice on the show, I think. And both times I've commented that I thought it was quite expensive. I think it was trading at a P of, about 22, and it's maybe 23 even. And it's now pulled back to about 19. So it's in line with Unilever's. I think the valuation looks much more reasonable now. What about you?
No, I would agree with you. And I mean, back when we've been talking about it before, it was close to £80 a share. It was sort of £77, £75, and it's now pulled nearly 30% back, and it's about £55. And again, if I didn't already have Reckitt shares, I would probably be considering buying some, because I think it's, for the long term, I think it's a quality business. Yes, there are some concerns, but I think they're getting, selling the infant nutrition business is a good move, and becoming a healthier company. And I don't think in the current environment, like you say, 3.7% increase in revenue is bad at all, especially on the back of, Dettol sales during the pandemic. So I think it's reasonable, and the valuation isn't outrageous either. And they're probably shares that if you did buy them, you could sleep at night with them.
I'm just surprised it ran up as high as it did, to be honest, because I just think, we were talking about it last time we covered it. It's not, I think it was growing at about 10% last year, and it wasn't going to grow 10% every year. Even if the pandemic was going to carry on for 2 or 3 years longer, I still don't see how you just, it just seemed very expensive. Whereas now, in line with Unilever, it makes much more sense. It makes more sense,
yeah. But I suppose potentially it's what the rest of the market's doing, and with such uncertainty, maybe it's that it was going to be that reliable revenue stream, albeit perhaps at not such high volumes that people were maybe paying a little bit more for. I don't know. I certainly didn't add to it over that time, but I just held it, and I'm still quite happy to hold it. Shares of, I think they were on these results down about 8 or 9% in early trading, but it's not really a concern. Don't know whether I'll be adding to them. I'm quite happy with the position and reinvesting the dividends in the business. But not of great concern, to be honest. And I probably would agree with you, before, for what it is, it was a pretty top evaluation. But happy to continue holding them for the long term, and be interested to see how they do.
Yeah. So should we move on to Games Workshop?
Oh, yeah. So this is a bit of a darling, isn't it?
It is, yeah. Yeah, so we'll probably start with that one. So forget that. So for anyone who doesn't know Games Workshop, they make Warhammer, which I'm sure most people in the UK are familiar with, even if they've never actually collected it themselves. But in 5 years, the share price is up 2,332%. In 3 years, it's up 260%. In 1 year, it's up 24%.
It's a monster.
Yeah, it's really, really impressive. So they have come out with their full year results, and revenue has increased 31% to 353.2 million. Operating profit has increased 68.6% to 151.7 million. Earnings per share has increased 70.4% to 372p a share. Those are obviously fantastic figures, but I'll just gloss over them for now because there's some quite interesting stuff in the results. So I'll just read some interesting parts from the strategic report firstly. Our ambition remains clear: to make the best fantasy miniatures in the world, to engage and inspire our customers, and to sell our products globally at a profit. We intend to do this forever. Our decisions are focused on long-term success, not short-term gains. We make fantasy miniatures based in our endless imaginary worlds. This gives us control over the imagery and styles we use, and ownership of the intellectual property. Aside from our core business, we're constantly looking to grow our licensing income from opportunities to use our IP in other markets. Our retail channel is supported by our own online store, which has a full range of products, and our independent stockist and trade accounts across the world. These independent accounts do a great job supporting our customers in parts of the world where we either have not yet opened one of our stores or where it is not commercially viable for us to have one. Our long-term goal is to have all three channels, retail, trade, and online, growing in harmony. We will always have more independent accounts than our own stores. Our strategy is to grow our business through geographic spread, growing all three of the complementary channels. We measure our long-term success by seeking a high return on investment. In the short term, we measure our success on our ability to grow sales while maintaining our core business operating profit margin at current levels. In the design section, it said we design all our products at our HQ in Nottingham, employing 262 people. The design studio creates all the IP and all the associated miniatures, artwork, games, and publications that we sell. Annually, these specialist staff produce hundreds of new sculpts, illustrations, rules, stories, etc., enabling us to deliver new products every week and continue to keep our customers engaged and excited. In 2020 to 21, we invested 12.7 million in the studio, including software costs, with a further 4.4 million spent on tooling for new plastic miniatures. We're committed to investing in these areas at an appropriate level every year. In manufacturing, they said we're proud to manufacture our product in Nottingham. It's where we started and where we intend to stay. During the year, we completed the work on Factory 2 of increasing our production facilities in Nottingham. With the expansion of our tooling facility and further office space, we also purchased 2 further pieces of land next to our main site, which will allow for further expansion. Our product is distributed from our main warehouse in the Nottingham HQ or our rented warehouse facility approximately 25 minutes from the main HQ. These facilities supply our 2 hubs, one in Memphis, Tennessee, and the other in Sydney, Australia. Between these 4 facilities, we are then able to directly supply our independent retailers, our own retail stores, and fulfill our online orders. The upgrade of the Memphis facility, as well as moving into this new rented warehouse near Nottingham, are both nearing operational completion. In retail, our stores provide the focus for the Warhammer hobby in their geographical area. Our stores only stock Games Workshop product. They are where we recruit the majority of our new customers. To do so, the stores don't offer a full range of our products, only starter sets, new release products, and the appropriate extended range. At the year end, we had 523 of our own retail stores in 23 countries. Our stores contributed 20% of the year's sales. We have 406 single staff stores, small sites, each only operated by one store manager. We've also 117 multi-staff stores, which, like our single staff stores, are constantly reviewed to ensure they remain profitable. If not, they will probably be converted to single staff stores. The bulk of our sales to independent retailers are made via our telesales teams based in Memphis and Nottingham. We also have small telesales teams in Sydney, Tokyo, Shanghai, Singapore, Hong Kong, and Kuala Lumpur. In 2021, we had 5,400 independent retailers, up from 4,900 in 2020 in 73 countries. We strive to deliver excellent service, operating in 23 languages, covering all time zones. 55% of our sales come from sales to independent retailers in the year reported. These sales are from their physical stores as well as their own website stores. Online, sales via our own web stores accounted for 25% of total sales. All our retail stores also have a web store terminal that allows our customers to access the full range from within the store. Our web stores are run centrally from our Nottingham HQ. It's quite a bit in the licensing segment. So it said we only intend to work with high caliber expert companies in each one. We focus the majority of our efforts on key franchises, specific interpretations of parts of our IPs, typically driven by video game or media products. For example, the Vermintide and Total War series of the games. In the year, we launched 9 new games, 5 PC, console, and 4 mobile, and continued to see successful sales of top titles supported by the ongoing release of extra content and expansions. The majority of video game income came from the ongoing success of existing titles this year, highlighting the long-term revenue stream generated by the franchise strategy and the lack of exposure to any one new release's performance. Several large franchise games were announced as launching in the next 12 months. There are currently 15 video games in development across all platforms, which will be released over the next few years. Whilst income is down due to lower levels of deals with high minimum guarantees compared to the prior year, actual sales of licensed products at retail value was the highest ever this year. In other words, more customers bought more Warhammer licensed products than ever, in excess of £133 million worth. So in terms of the split, 55% of sales come from trade, and that's up from 52% last year. 20% from retail, down from 29% last year, and 25% from online, up from 19% last year. Number of stores, they've got 531 in total, 140 in the UK, 160 in North America, 157 in continental Europe, 49 in Australia, and 25 in Asia. They highlighted that online sales continue to grow by 70% compared to the same period last year, and that more than made up for sales volume shortfalls when physical stores were closed. Gross margins improved in the year from 67% to 72.7%. And there was an interesting slide where it showed the return on capital percentage before licensing income's taken into account. So the return on capital, do you want to guess what it was in 2021, John?
Oh, I don't know. No, tell me, Sam.
184%.
Oh my goodness. Yeah.
They've had a good year. 2017,
Yeah.
72%, up to 120% in 2018, down to 100% in 2019, down to 94% in 2020, and then it's doubled to 184% in 2021. So in terms of the valuation, it's currently trading at a PE ratio of 30.48 with a dividend yield of 0.5%. I'll just have a check. I wonder if they suspended dividends in the pandemic. Not that it matters because you're not buying it for the dividend, are you? Buying it for No, they didn't. It doesn't look like they did suspend dividends, so it's just they're not really paying it out of it. But so yeah, John, thoughts on these results and Games Workshop as a business?
Well, they're pretty incredible results, really, and reflected in the share price growth. The valuation, I don't think, is outrageous, but it's it almost reminds me in some ways like a little almost a little British Disney.
As I was reading these, I was just thinking, you know what, I would really not be displeased if Disney were to announce they were buying this.
Yeah, no, I was actually thinking, because looking at the market cap, it's not a massive company. It's only 2 or 3 billion pounds, and it's like
3.73 billion.
Oh, sorry. Okay.
But that's chunk change for Disney.
Exactly. And just putting it in their universe as well, think what they could do with it. Yeah, it's an incredible company, really. And it's one of those ones that I've seen it a few times, just that you think, oh, it just can't, it kind of can't continue. And I have probably personally written it off a bit because of that, because it's every time it's so good. Well, actually, I probably should have been, more appreciative of that, and all of that valuable IP that they have, and just bought it up.
It's hard to have bought this stock and not made money.
Yeah.
But
no, that's right.
I think it's a fantastic business. I agree. I mean, if you think what Disney could do with that business, the most comparable, it's quite comparable really to where Marvel was before the Disney acquisition, I think.
Yeah. And
I know it's more like adult themed, than superheroes, but there's so much they could do with that. And it's like I say, it's not like 3.73 billion. Disney could just come in and buy it for 5 billion.
Yeah.
I mean, even if they pay 10, there's so much more Disney can do with those brands.
Yeah.
And as well, not that you'd buy it hoping Disney were to do a takeover. It's just what I'd quite like to see as a Disney shareholder. But even when you look at that store count, they've only got 20 more stores in North America than they have in the UK. And they've only got 25 stores in Asia. So to me, it looks like it's just getting started.
Yeah. I tend to agree with you. I think it's one I'm sadly more interested in now than I was a few years ago, but I would be considering even, and a price to earnings of 30. I know it's had huge growth so far, but it's not outrageous, is it really?
I think it's pretty reasonable. I know they've probably had a bump from people staying at home from the pandemic, but if you look at the past 5 years of financials, it's a business that's delivered even pre-pandemic.
Yeah.
Just get it up. Yeah, so revenue growth from 2017 to 2021 inclusive, 158 million, 221, 256, 269, 353. And it's still pretty small, I think. I don't know why I don't own it.
Yes. Yeah.
I mean, I remember it was one of when I first got interested in investing, it was
Yeah.
actually one of the first stocks I had a look at.
Yeah.
And I remember it had run up not too long after I first looked at it from about what would it have been? What is it now? Is it £113 a share?
Yeah, it is. Yeah.
I think it just run up from about £15 a share to 35. And
Yeah,
I thought, well, I'll maybe have a look when it comes back down.
Well, that's always the risk you
And
run.
then I remember it running from 35 to about 60, and I did the same thing.
Yeah.
So I'm actually at the point where I might just go out on Monday and get a start position in it, just so I've got just a small amount, just so I've got something. Because I don't know why I don't own it.
Yeah, no. Again, similar, I think.
And I think the licensing as well. There's a lot they can do, because I think if they're not acquired by someone like Disney, licensing is probably the best way to go with that. But if you remember, do you remember there was a World of Warcraft movie a few years ago?
Yeah.
It did really badly in the West, but in China they loved it. I don't know why, but it's that sort of thing where I could see them doing quite well with that, and they wouldn't need to be that successful for it to seriously contribute to the
great British company.
It is, yeah. Right, so should we move on to Shell?
Yeah, the last British company of the week. So Shell, I'm sure everybody's heard of Shell. It's the largest oil company on the FTSE 100 and one of the largest companies listed on the FTSE 100 as well. So they had their half-year results out this week, which buoyed the index. The second quarter revenues came in at $60.5 billion, which was up from $32.5 billion a year ago on the strong recovery in oil and gas prices. Underlying operating profits came in at $5.5 billion, up from $638 million last year. And if we break those results down a little bit more, Shell's integrated gas business saw underlying profits grow to $1.6 billion, and that's up from $362 million a year ago, with a modest increase in production and higher prices. In the upstream, underlying profits came in at $2.5 billion compared with 1.5 loss last year, again driven by higher prices, and there was actually a small decrease in production. In the oil products division, underlying profit came in at $1.3 billion, down from $2.4 billion last year, which reflected lower profit in the refining and trading business, with lower refining margins, higher operating expenses, and reduced trading profits as volatility reduced. In the chemicals division, underlying profits more than tripled on the year to $270 million with stronger margins. Free cash flow in the second quarter came in at $9.7 billion compared with just 0.2 in the second quarter of 2020. And that's despite a 23.2% increase in capital expenditure, which hit $4.2 billion. Net debt stood at $65.7 billion at the end of the quarter, down from $77.8 billion a year earlier. And gearing fell from 32.7% to 27.7%. Shell announced an interim dividend of 24 cents a share, which is up 50% year on year, and also a $2 billion share buyback. And shares were up 4.2% on the news in early trading. In terms of valuation, Shell currently has forward price to earnings of 8.2 compared with the 10-year average of 11.5 and a prospective dividend yield of about 3.5%. Sam, what were your thoughts on Shell's results?
This is the first time we've covered it where I thought it actually looks like quite a decent company.
Okay, because I think we were most pessimistic literally at the bottom, and that was pre-vaccine back in the autumn of last year.
Yeah, but I don't know if I said it at the time, but I'd much rather pay a higher price for it now. Yeah, you've got a lot more, and I mean these are good results. Obviously, it's not up against the most difficult comparatives, but they are still good results. The dividend increase is pretty good. A PE of 8, I think that's pretty reasonably priced, really. Because one thing I've talked about is, well, what's the long-term future of this business? And I think it's got 8 years left. How long it's going to take to distribute that cash to shareholders. So yeah, a PE of 8, I think it looks pretty reasonable. It's the sort of thing where, like, if someone wants to have it in their portfolio now, I'd sort of think, oh, I can see why, if that's the sort of thing you're interested in. Whereas, you know, a couple of years ago, I was thinking more like, well, why would you want that? I think it looks a lot healthier now than it did a year or 18 months ago.
And I mean, they hadn't cut the dividend since the Second World War, and then they did cut it, and, you know, you saw a big retraction in the price, but that was probably a sensible move.
Yeah.
And they've got, a more progressive policy going forward. But yeah, I mean, I suppose the big question with Shell is long-term future of oil. You would factor into it how much cash is going to be returned in the meantime, even if oil is not, you know, as most people expect, the long-term future. And then there are a lot of uncertainties. But does Shell continue to be an energy company in the future? And is it going to be able to be profitable doing that? So whether it's hydrogen, electricity, renewables, I mean, I suppose that's the big question.
I think as well, you've got to remember that prospective dividend yield of 3.4%. It's pretty good. I'd expect it to possibly, you know, it might go up even more based on, you know, how far it was cut. You know, I appreciate it's like more progressive dividend policy. It might rise and fall with the earnings. But that 2 billion share buyback, I mean, that's on 110 billion market cap, but that's effectively like another 1.5% of yield you're getting, really.
Yeah, that's right. And that will shore up, it'll boost the share price, obviously. So, yeah, no, I mean, I own Shell. I didn't sell any. I think I actually added a small amount to it when the shares were trading quite low. I wouldn't say it was a lowly valuation at the time, but the share price was lower back in 2020. And yeah, again, it's probably one that I'd be happy to hold and be rewarded with that dividend payment on the basis of the uncertain future ahead of it.
All right, should we move on to Alphabet then?
Yes, so Alphabet, Google, as it's known to most people, but it's obviously not just Google as a company. It does include other parts of the business. Do you want to lead on this, Sam?
Yep, so Alphabet have come out with their Q2 results. And I mean, the figures they are actually mind-boggling, to be honest. But yeah, revenues of 61.8 billion, and that was up 62% year over year. Operating income of 19.3 billion, and all these figures are in dollars, by the way, and that gives an operating margin of 31%. The net income was 18.5 billion, and that was up 166% year over year. So in terms of the split of revenue, Google Search made up 35.8 billion of revenue, and that was up 68%. YouTube made up 7 billion of revenue, and that was up 84%. And Google Network made up 7.5 billion of revenue. Google Cloud made up 4.6 billion, and that was up 54%. And other bets is just tiny still. The valuation is trading at a P ratio of 29.34, and that puts it at a market cap of 1.798 trillion with a T. I don't think there's any point going into them in more detail or reading out CEO statement or anything, because these are just ridiculous numbers from a company of that size.
Yeah.
And for such a high quality business, I think a P ratio of 29 is pretty reasonable, to be honest. What about you?
I mean, probably I would agree with you on that, but it's to say a P ratio of 29 is reasonable.
Well, this is for a company that grew revenue 68%.
No, Sam, I do agree. It's just, I suppose it's a staggering company with staggering numbers, and of that size as well, like you say. I mean, I don't know how that compares with the market cap of the whole of the FTSE 100, but
it must be bigger, because Apple was bigger, and that was when it was at about 1 trillion valuation, wasn't it?
Oh my goodness! Yeah. I'll fact check, but yeah, probably. So yeah, no, it's, I mean, incredible. I don't own Google directly, but I've got, my world tracker, essentially, a Vanguard all world index, and that has, I mean, I guess it's probably at least 1% Google, and the FANG stocks probably make up, maybe, don't know, off the top of my head, maybe 10%. Do you think?
Well, they make up 25% of the S&P alone.
Yeah, so it's so it's probably a decent proportion. But is Google a company I like? Certainly. Would I be buying directly? I don't know. I'm quite happy having it as part of my sort of global fund for sure. And when it's producing, results like this, it's incredible, really. Would you buy Google directly, do you think, or Alphabet directly?
I mean, I wouldn't be against it. I think if I was in America, I'd be a lot more likely to, just because I think if that was my home market, with valuations being as stretched as they are, you can see why, the FANG stocks, they are quite cheap in comparison, because for the quality of the company and the growth they're delivering, I mean, if you take any one of the FANG stocks, they look pretty reasonable. I mean, 29 PE, I mean, I know Facebook's gone up a bit since we last covered it, but I think that's at about 30 still, and that's growing about 40% year over year. And it's just, the question is, how long can they carry on the growth for? But it's not going to drop to zero. It's going to be a slow decline. So if they're growing 40% year over year, you can be sure they're going to grow a decent amount next year as well.
And those valuations, as you would say, would be coming down on that basis. So
so I've actually fact checked as well. The FTSE 100 market cap is now £1.8 trillion. So it is actually smaller than the FTSE. $1.798 trillion. So what's that, about £1.5 trillion? So it's about 75 to 80% of the FTSE 100.
Which is pretty incredible, really.
It is, yeah.
And when you think of Shell as such a big company, and and Unilever for that matter, with market caps
and Reckitt,
and Reckitt, but like with over 100 billion, and then Google or Alphabet just dwarfing that. But I mean, I don't know what YouTube would have a valuation of it, on its own, but it's pretty incredible.
I mean, what YouTube revenues for the quarter was $7 billion. And that it grew 84% year over year. I struggled. I mean, what would that be? I know it's going to be it might be more lumpy than that, but if you say it's 28 billion of revenue for the year, that's going to be pretty high margin. I mean, given the valuation some of these other things trade at, it's you're in the hundreds of billions at least. It's unbelievable.
I suppose this is you see the growth reflected in the S&P 500 as well.
But what about the terminal value of Google search? Because at some point, we're probably going to move on from search to some other medium, don't you think? Whether it's voice or even if you've got chips in your head or something. In 50 years' time, are people still going to be searching on a browser?
But I think even if that sort of, I suppose, it changes, do you not think Google would be at the forefront of that change?
I think they struggle with it, because I think if you look at how dependent they are on search, I mean, YouTube's incredible, but then the clouds, I guess they've got the cloud as well.
Yeah.
But I mean, if you look at other bets, they've not. The problem is YouTube could be a $500 billion business on its own, or $1 trillion business, but that's not enough to replace search. The search is just, it's like the golden goose, isn't it? I mean, how do you replace that? There's a handful of businesses in the world that are as good as Google search is.
Google search, And
you're talking it's kind of like Apple without the iPhone. I know they're getting more services revenue, but in 50 years' time, will people still be buying an iPhone every year? And how do they replace that?
I know it is difficult, but I don't. We're not there yet for sure.
Definitely. No, it's a long way off. And it's like with Facebook, for example, in 50 years' time, are people still going to be using Facebook? But then if you look at that, have you seen what Zuckerberg's doing with the Oculus? And he thinks the next platform is going to be virtual reality, which is why he's betting so heavily on the Oculus. So it's almost like this cannibalization where I think it's not inconceivable that he thinks the Oculus will almost replace Facebook as the dominant medium of how people interact. And but that, again, it's got a long way to go.
Absolutely.
To catch Facebook.
Absolutely.
Anyway, of the 6 companies we've covered this week, and I'd say all 6 have had good results actually. So British American Tobacco, Unilever, Reckitt Benckiser, Games Workshop, Shell, and Alphabet. If you had to buy one, which one would it be?
Oh. It's a difficult one, actually. You definitely got very different, different mix of companies. I mean, you've got some that are very much value plays, like that would be your British American at one end, and then you've got sort of your growth in terms of Games Workshop and Alphabet. And then something, almost in the middle with those defensive companies, Unilever and Reckitt, but they've got, obviously more growth than you'd expect from a British American Tobacco. I would probably be edging towards a Games Workshop, possibly Alphabet this week, I think. And saying that, I do have, Unilever, and that's one of my favorite companies, but I'd probably be going for a Games Workshop or an Alphabet. What about you?
I'd go for Games Workshop. I think for me, I'm probably going to go out and get a starter position in it next week, I think. But this week, it's 6 sets of very good results, I think. Even Shell, which on other weeks I've slated, those are impressive results, and the valuation's looking a lot better. Reckitt is, it had looked expensive previously. I think the valuation's pretty reasonable. I think at least 5 of these companies on a normal week are probably the top pick.
Yeah.
So, but we've got a book review quickly as well, so I'm going to keep it very quick. But it's called The Great Depression: A Diary by Benjamin Roth. And Benjamin Roth, he was a lawyer in a place called Youngstown in the US, and he was working in the Great Depression. And what happens is the work's obviously rubbish because of the Great Depression, and he starts taking more of an interest in politics and economics and Hoover's policies and what he's doing, and he wants to learn more about what's going on. So he starts studying it, and he keeps a diary. He starts making a diary as he's doing this. So it's really interesting because at the start, so what's happened is this is a real guy with a real diary, and his son has compiled the diaries and published them years later, which is how it's come about. But at the start, he's quite confused and doesn't, he starts almost as a beginner, and by the end, he's got some quite interesting opinions and thoughts. And it's obviously very interesting to just see how all the policies in real time of Hoover and Roosevelt actually impacted him. And one thing that's quite interesting as well, even though it doesn't relate to investing as much, is in the Depression, you've obviously, the asset, as a professional, he was almost left behind because a lot of the New Deal, it really impacted the working man. And then when it didn't impact the working man, asset prices were going back up. So the rich were, better off as well. But then the professionals, what's happening was no one was wanting to pay for solicitors' fees. So no one was buying new buildings, no one was getting new leases or anything like that, where his fees would come from. And he couldn't really collect the fees off anyone because no one, it's kind of like, it's a bit like a dentist, I imagine. Like if you're in a depression and your tooth hurts, you probably either put up with it or just get someone to pull the tooth out rather than spend the money on a dentist. So it's probably quite like that, but it's really, really interesting. And as well, he is taking an interest in the market. So it's him formulating his own investment theories as you go through the book. And it is so quotable. There's just so many great quotes in there that he's come up with in his little diary, but I would definitely recommend it.
Have you taken anything from it yourself for, from the perspective of today and how the markets are?
I think one thing that I found really interesting, so he was, at the time, there was a lot of people that were very supportive of hard money, and it's not really talked about, it's not really talked about as much now, but a lot of Hoover's policies, although they're criticised by historians and economists retrospectively, at the time, people thought he was doing the right thing. But what he was doing was he was leading to a contraction of the money supply, and he actually made, the general consensus now is that his policies made things worse. When Roosevelt came in with the New Deal, people did not want him to go off the gold standard. They didn't want him to devalue the dollar. And all this money printing, there was a lot of fear about the national debt and how high it was and the US's ability to pay it. And when you read the figures now, they're laughable because they're so small. The US probably takes on more debt in a day than the total debt that he's worried about. Yeah. And I think that's quite interesting because, again, he's very, very worried about inflation, which certainly in the 30s you didn't really get. I think the large inflation didn't really come along until they properly came off the gold standard in the 70s. So he's got 40 years where he was worried about inflation that, it took 40 years to arrive. So I think it's a good example of the Charlie Munger quote that a good system can take a lot of abuse. So people who look at the system now, I think whilst it is an abuse of the system, it might be able to take this for another 20 or 30 years. And the reality is we just don't know because so many people were so sure of what was going to happen. and how much of a disaster Roosevelt's policies were going to be. And then that didn't actually happen. So it's definitely worth reading.
Yeah, very good. Okay.
Next week, we're actually going to be covering more companies reported this week that we didn't get to cover, just because what happens is with earnings season, it's very, very busy for a few weeks, and then it's going to drop off. So we can spend, we spend a few weeks catching up, but we get to cover all the companies we're interested in. I think that's a better approach than having to look at Rank Group again in a few weeks' time.
That's a bit harsh. Okay. Don't want to get any complaints. Okay, we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.